Hi, everyone. Welcome back to the Business from Scratch podcast. I'm your host, Abby McGee. Today's episode is all about tax structure, but don't run for the hills. I promise this will be painless, and it has the potential to save you thousands of dollars a year. First of all, I'm a business owner, not a CPA or a tax professional. Everything in this episode is for educational purposes, but please consult your own accountant or tax advisor before making any changes to your business structure. So, at some point in your business journey, usually when you start making some real money, someone is going to say to you, you should probably look at becoming an S-Corp. And if you're like most business owners, you're going to nod. You're going to say, yeah, definitely. And then you're going to go home and not know what in the world they are talking about. That was me a few years ago. So today I want to actually explain this in plain language so that we can all understand what an S-Corp is, when it makes sense to switch, and what actually changes in your day-to-day once you do. So let's get into it. You're listening to Business from Scratch, the podcast for people building businesses they love without losing themselves along the way. I'm your host, Abby McGee. Let's get started. If you're a small business owner and you've filed any kind of paperwork with your state, you're probably an LLC or a limited liability company. And starting as an LLC is the right call usually. It's low cost, straightforward to set up, and the most important thing it does is put a wall between your personal finances and your business. If someone sues the business, your house isn't on the line. It's just not the most efficient tax structure once you start making real money, and that's what we're going to talk about today. By default, an LLC is something the IRS basically ignores. And what I mean by that is an LLC on its own doesn't have a tax structure. The IRS calls it a pass-through entity, which means the profit your business makes passes straight through to your personal tax return. You pay income tax on it, and you pay self-employment tax on it. That self-employment tax, which is 15.3%, is the one that stings because you're paying both sides of it, the employer side and the employee side. When you work for someone else, your employer pays half of that. When you work for yourself, you pay all of it on every dollar of profit. But that's the problem an S-Corp solves. It's easy to get confused here because an S-Corp is not a business structure. It's a tax election. You're not changing what your business is. You're changing how the IRS taxes it. You can stay an LLC and elect S-Corp tax treatment. Most small business owners end up doing exactly that. So what changes? Under S-Corp taxation, you split your income into two buckets. Bucket one is your salary. Bucket two holds distributions or your share of the profit. And here's why that matters. Self-employment tax only applies to your salary, not your distributions. So if your business makes $200,000 in profit and you pay yourself an $80,000 salary, you only pay that 15.3% self-employment tax on the $80,000, not on the full $200,000. On the remaining $120,000 you take as a distribution, you still pay income tax, but you do not pay self-employment tax. And that difference, depending on your profit level, can be tens of thousands of dollars a year. That's real money that can make a huge difference in your life and in your business. So the question everyone wants the answer to is, when does it actually make sense to switch? And the honest answer is, it kind of depends. So here's a practical framework to help you make that decision. The general rule of thumb most accountants use is that the S-Corp election starts making financial sense when your business is generating somewhere around $40,000 to $50,000 in net profit per year, which is that number after expenses, after everything. Below that threshold, the administrative cost of running an S-Corp can eat up that savings. Above that threshold, you're usually leaving money on the table by not switching. The higher your profit, the more the math tips in your favor. For me, it was a conversation with my CPA where I finally understood why this matters, and then I immediately thought, yes, please sign me up. This episode is brought to you by Salt and Charm. We're a catering and events company based right here in Wilmington, North Carolina, and we've been feeding this community for a while now. We offer full-service catering for weddings, corporate events, and private dinners, the kind of food and hospitality that makes people stop mid-conversation and say, "Wait, what was that?" We also offer meal prep delivery and pickup because it turns out the people who hire us for their celebrations also want someone to handle Tuesday night dinner. And honestly, same. If you're planning an event or you're just tired of figuring out what's for dinner, we would love to be your people. Find us at saltandcharm.co or on Instagram at saltandcharm. And just for our listeners here on the podcast, use code podcast for 10% off your next meal prep purchase. Now, before you get too excited about distributions, there's a little catch. The IRS requires that if you're an S-Corp owner working in your business, you must pay yourself a reasonable salary, not a token salary, not $1 a year, a salary that actually reflects what you'd have to pay someone else to do your job. And this is where people can get into trouble. If you try to take everything as a distribution and pay yourself nothing, the IRS will notice and they will not be pleased. The reasonable salary requirement is real, it's enforced, and it's worth taking seriously. Your accountant can help you figure out what reasonable looks like for your role, for your industry, and your revenue level. So, do not skip this step. Now let's talk about what actually changes once you make the S-Corp election, because the tax savings are the headline, but the operational reality is the fine print. And as we all figure out at some point, the fine print is what catches us off guard. Here's what actually changes when you make the switch. Number one, you become your own employee. That means you have to run payroll for yourself on a regular schedule, just like you would pay any other employee. You're going to withhold taxes from your own paycheck, just like any other employer would. You're going to file payroll taxes and issue yourself a W-2 at the end of the year. If you've never run payroll before, this can feel bizarre, but the good news is that payroll software like Gusto, QuickBooks, or Square Payroll makes this pretty manageable. But it is a real ongoing administrative task that you or someone on your team has to own. Number two, your tax filings get a little more complex. As a single member LLC, you probably filed a Schedule C with your personal return. That's clean and simple. As an S-Corp, your business now files its own tax return, which is a Form 1120-S, in addition to your personal return. That usually means higher accounting fees, so don't forget to budget for that. A good accountant pays for themselves many times over with the savings they help you find, but go in with eyes open about what it actually costs. Number three, quarterly estimated taxes change. As an LLC, you were most likely making quarterly estimated tax payments directly to the IRS. As an S-Corp with payroll, taxes are being withheld from your salary throughout the year, which can simplify your quarterly obligations. But how this works specifically for you depends on your situation. So, say it with me, talk to your accountant. Number four, you need a dedicated business bank account if you don't already have one. You should have this regardless, but with an S-Corp, the line between business and personal finances has to be clean, and that is non-negotiable. Commingling funds as an S-Corp is a much bigger problem than it is as a basic LLC. So once you've run the math and you've talked to your accountant and you've decided it's time, here's what the process actually looks like. First, you file what's called a Form 2553 with the IRS. That's the S-Corp election form. There are deadlines. If you want the election to apply to the current year, you generally need to file within 75 days of the start of that year or within 75 days of forming your LLC. Second, you're going to need to set up payroll. Pick a payroll provider, determine your reasonable salary, and get your first payroll run scheduled. Third, work with your accountant to make sure your bookkeeping reflects the new structure. How you categorize your own compensation is going to change. Make sure your books are set up correctly from day one. And that's really it. It sounds like a lot, but most of it is a one-time setup. Once the system is running, it just runs. Now, before we bring this to a close, let's talk big picture. The S-Corp conversation is really a proxy for a bigger conversation, which is, are you treating your business like a business? Are you paying attention to your tax strategy? Do you have an accountant you actually talk to, not just someone you hand a shoebox to once a year? The business owners I know who are building real wealth are the ones who understand how money moves through their business, not just how much money is coming in, but how much they're keeping and what structure they're using to protect it. The S-Corp election is one tool in that toolkit. It's not magic. It doesn't fix a business that isn't profitable. But if you've got a profitable business and you're still paying self-employment tax on every dollar, you owe it to yourself to have this conversation. So here's your homework from this episode. If your business is generating more than $40,000 to $50,000 in net profit per year, call your accountant this week, not next quarter, this week, and ask them, does an S-Corp election make sense for me? If you don't have an accountant, then that's your first homework assignment. Get one, not a tax preparer, an actual accountant or CPA who works with small business owners and can talk strategy with you and not just file your return. The difference between someone who prepares your taxes and someone who helps you plan for them is often tens of thousands of dollars a year. Okay? Let's do it. Thank you so much for being here today and learning with me. I'm so excited about what you are building and would love to hear about your business. Follow us on Instagram at BizFromScratchPod and shoot me a DM or leave us a comment so we can learn more about you. And thank you for sharing the show with your business owner network. That's how we grow. I'll see you again next week and every Tuesday for new episodes. Thanks for joining me on Business from Scratch. Follow the show for more honest conversations about building a business that works for you.